All right, welcome everybody to our halftime report, looking at the mid-year outlook for 2025. Today, first of all, we're using a new format. We hope you like it. It's more visual and informative, and I'll have quite a number of comments to be making about not only what has transpired, but also kind of how we see the macro and the market moving forward. Um, we're going to explore obviously the economy, markets at the halftime. When I say halftime, a lot of these information will be as of July 30th. We now have like more real-time data, which in this new format, which is good. And then we'll talk a little bit about where we potentially see things, and then open it up to Q&A. Here's a quick reminder, this webinar is for informational purposes only. We're not actually making any specific recommendations. Any information that we provide in this is, uh, is strictly for general information purposes. If any of the comments or things that strike you and you want to talk about your personal portfolio with us, feel free to schedule a personal consultation. Obviously, much of the data in here moves over time, so all the information is subject to change. Here's today's agenda. We're going to talk a little bit about halftime and quarterly market update, especially focus on Q2 2025. We'll look at the economic outlook for 2025, then move on to some GDP forecasts, and I'll close it out with some key takeaways, some thoughts, and then also some Q&A. I'm going to start out by providing some general information about market performance in the past, such as this chart, which helps contextualize the S&P 500's historical performance by showing the frequency of annual returns in different ranges. Notice how most years have positive returns. The fact that 66 out of 99 or 67% have had positive returns, and highlights the importance of staying invested over time, even during periods of volatility, as the odds historically favor the long-term investor. This chart illustrates the S&P 500 Total Return Index's quarterly performance since 1988, ranked from worst to best. Notably, the second quarter of 2025 delivered a strong 10.9% return, among the top historical quarters, following a solid 10.6% gain in Q1 of 2024. That's the year-on-year comparison. This strong performance in the second quarter came after a weak first quarter, which saw a negative 4.3% decline. The current quarter-to-date return as of July 30th stands at 2.6%, highlighting the market's ongoing recovery. The chart underscores how quarterly market returns can be often volatile and reinforce the importance of a long-term perspective. Taking a quick look at global oil prices, this chart highlights the volatility of those global oil prices, with West Texas Intermediate and Brent crude, the two primary benchmarks for global oil, moving largely in tandem. WTI is typically used as the US benchmark, while Brent serves as the global standard. As of July 30th, 2025, WTI sits at $71.09, well off post-Ukraine war highs. This level suggests moderation in inflation pressures, which is generally positive for consumers and the broader economy. However, it can be a headwind for energy sector earnings, as oil producers typically thrive in higher price environments. Another quick perspective chart for you to consider. This is war in the stock market. A lot of people are obviously, or have been, concerned about the global conflicts that have been erupting around the globe in the last year or so. But this is a great historical reference. It shows that while wars initially cause market stress, equities tend to recover and even thrive long term. For example, with the Gulf War, the S&P 500 rose over 90% in the 5 years subsequent. So the lesson is that geopolitical shocks kind of rarely disrupt long-term trends. And I think that's when we say long-term trends, I mean long-term macroeconomic trends that often underlie whether markets are in favorable trends or not. This chart shows the GDP growth components over time. First quarter 2025 GDP contracted by roughly -5%, driven primarily by tariff-related disruptions that triggered a sharp 4.9% drag from net exports and a steep 3.1% decline in private investment. These trade policy shocks inflated imports and suppressed business activity, weighing heavily on overall economic output. In the second quarter, however, GDP rebounded to a healthy 3% pace thanks to a 5% surge in net exports, which is likely a reversal of the first quarter imbalances and continued strength in consumer spending. Averaging both quarters out, first half 2025 GDP growth is tracking close to 1.25%, suggesting a slow but stabilizing economy. If conditions normalize and business investment firms up, the second half of the year could see modest but improved momentum. However, if leading economic indicators continue to soften, it may signal slower growth ahead and raise the risk of sub 1% GDP in the back half of the year. This chart puts recent GDP growth in historical context, showing that while the first quarter's -5% decline was modest and the second quarter's 3 percentage point rebound solid, both fall well within the typical post-war World War II range. It underscores how today's economic fluctuations, while notable, are far less extreme than, say, like the pandemic era swings, helping investors keep short-term moves in proper perspective. The recent decline in both 1 and 5-year consumer inflation expectation is a positive signal, suggesting that inflation fears may be easing after recent spikes. While expectations remain above historical norms, the downward move could help anchor long-term inflation and reduce pressure on the Fed to tighten policy further, potentially supporting a more stable economic and market environment. Yet this lies in contrast to the latest comments coming from the Fed regarding potential increases in inflation. This chart highlights the close long-term relationship between S&P 500 earnings and stock prices. As of July 30th, 2025, the index sits at 6,363 with trailing earnings per share at a record $250, both near all-time highs. While stock prices have surged, earnings growth has kept pace, suggesting valuations are elevated but not extreme by historical standards. Unlike prior peaks during the tech and housing bubbles when prices ran far ahead of earnings, today's market appears more grounded in fundamentals. Sustained earnings strength will be key to justifying current valuations and supporting further market gains. Looking ahead, corporate profit margins will play a critical role. If companies can maintain or expand margins amid slowing inflation and stabilizing input costs, earnings growth could remain resilient. However, if margins come under pressure from rising labor costs or weaker pricing power, valuations could face headwinds even if revenues remain solid. Now, taking a quick look at the Federal Reserve, this dot plot reveals expectations among Federal Open Market Committee members for future interest rates. There's still quite a bit of variation, or what we call dispersion, in the 2025 and 2026 projections, but the median forecast declines steadily. This reflects that the Fed's intention is to ease eventually. Markets may remain volatile until there's a consensus on the actual pace of these cuts. And here's another look at it. The forward implied rates, you can see this going out through 2027, looking at basically market implied expectations. We can see a clear downward trajectory in Fed funds rates, suggesting multiple cuts expected through 2026. It shows that markets are pricing in a gradual easing cycle, even if the Fed remains non-committal. This chart illustrates the sharp and sustained rise in U.S. federal debt as a percentage of GDP, with gross debt reaching 121% and net debt at 97% as of early 2025, more than double the 50-year average of net debt 47. By net debt, we mean debt that's net of debt held by other government agencies. This growing debt burden poses significant challenges for the economy, especially as interest rates have normalized from historic lows. A higher debt load means the government must allocate more of its budget to interest payments, crowding out spending on infrastructure, education, and innovation, all key drivers of long-term growth. More importantly for markets, elevated government debt contributes to higher baseline interest rates, pushing up the cost of capital across the economy. This affects not just treasury yields, but also the rates at which corporations can borrow to finance expansion, R&D, and strategic investments. As the risk-free rate rises, hurdle rates for investment decisions also increase, leading businesses to become more selective with capital deployment. Over time, this can dampen corporate earnings and limit the broader economy's productive capacity. So the reason why I point this out is because as investors and also as voters, you need to think about this, because addressing the structural drivers of debt, such as entitlement spending, tax policy, government spending programs alike, will be critical to restoring balance and creating an environment where both public and private sector investment can thrive. This chart is a quick look at the US dollar. While still relatively strong compared to its long-term average, has weakened in 2025, with the dollar index retreating to 100 and the trade-weighted index trending lower as well. This decline is somewhat surprising given that tariffs, like those recently implemented, typically strengthen a currency by reducing imports and boosting domestic demand. However, the current dollar weakness may reflect broader investor concerns about U.S. fiscal sustainability, slowing economic momentum, and shifting interest rate expectations as other central banks maintain or raise rates while the Fed potentially nears a pausing or easing cycle. Trade tensions, of course, may also be playing a role as tariffs disrupt global supply chains and weaken investor confidence. However, a weaker dollar has mixed implications. On the one hand, it can benefit U.S. exporters by making American goods and services more competitive abroad, potentially boosting corporate revenues and earnings. This can be a tailwind for large multinational firms and the stock market. On the other hand, a falling dollar can stoke inflation by raising the cost of imported goods, which could put pressure on profit margins and limit consumer spending. For capital markets, the direction of the dollar often influences sector leadership, with international stocks and commodity-linked sectors like energy and materials tending to outperform in weaker dollar environments. I really like this chart. It really shows the connection between valuations and forward returns. It illustrates the long-term inverse relationship between the S&P 500's forward price to earnings ratio and subsequent market returns. Historically, when valuations are high, such as today's forward PE of 22.5, forward 10-year returns tend to be lower. Based on the data, the implied 10-year annualized return at this valuation level is approximately 3.5%, well below historical averages. Notably, the chart, this is a key point, the chart shows that valuation is a much stronger prediction of long-term returns than of short-term returns. This reinforces a key principle in investing. While valuations may tell us little about next quarter's returns, they are a powerful guide to long-run outcomes. For context, the long-term average forward PE is closer to 16 to 17, and when markets have started from those more moderate levels, 10-year returns have averaged closer to 8 to 10% annually. With current valuations well above average, investors should temper expectations and prioritize a long-term horizon and diversified asset allocation to navigate a potentially lower return environment. Now, that said, one wild card is artificial intelligence. If AI leads to sustained gains in productivity and operating efficiency, it could lift corporate margins across many different economic sectors. In that case, earnings growth could outpace historical norms, potentially justifying higher forward multiples than in past cycles. And I can't stress this enough. I mean, I think a lot of uh, people have already had a chance to experience how efficient AI can make their daily operations, both in personal household decisions and across business decisions. So uh, generally, and I'm optimistic of this, that AI is going to make work and life more efficient, and that's going to really help and boost productivity, which would justify higher price earnings multiples. So from an investor perspective, we need to really keep that in mind. This chart visualizes the annual performance rotation across asset classes. In 2025 so far, international stocks and emerging markets are leading, reversing years of U.S. Stock market dominance. It's a reminder to diversify broadly. Leadership changes often and unpredictably. Notably, in the last 15 years, just 6 years show the S&P 500 leading. This supports the idea that asset allocation and tactical adjustments over time can help optimize portfolio returns. This chart shows a significant divergence in performance between large cap stocks and small cap stocks over the past decade, with large caps delivering an annualized return of 11.7% versus just 6.1% for small caps since 2015. This performance gap, driven largely by the dominance of technology and AI-related mega-cap stocks, illustrates the growing concentration of returns in just a handful of large names. Historically, however, this chart bucks the longer-term trend. Over the past 70 years, small caps have often outperformed large caps over full market cycles, particularly during periods of strong economic growth, rising risk appetite, and lower interest rates, particularly during periods of, sorry about that. The recent underperformance of small caps reflects a more challenging macro backdrop, higher rates, tighter credit conditions, and investor preference for quality and scale. From a style perspective, the chart underscores the importance of diversification. While large caps have led recently, market leadership tends to rotate over time. So maintaining exposure to both large and small caps helps investors participate in different phases of the cycle and potentially smooth long-term returns. Here's another really important chart to consider. It illustrates the historical return ranges for stocks, which are shown in dark blue, bonds in green, and mixed asset allocations over 1, 5, 10, and 20-year periods since World War II. It reveals two key takeaways. First, the longer the investment horizon, the more stable the return range becomes. And second, diversification significantly reduces volatility. Over 1 year periods, stocks have exhibited dramatic swings with returns ranging from plus 60% to minus 41%, while bonds have shown a narrow band of plus 35 to minus 16. However, by the 20-year mark, you can see that on the right, the range for stocks narrows substantially to plus 18 and plus 5%, and for bonds, it tightens further to plus 11 to plus 3. The most consistent outcomes from diversified portfolios where 60-40 and 40-60 mixes deliver smoother return paths across all time frames, with less downside in shorter periods and solid average returns over time. In essence, this chart reinforces two timeless investing principles. Time in the market matters, and diversification works. For investors concerned with volatility and long-term goals, staying invested in a balanced portfolio can often help manage risk while still capturing meaningful returns. Now let's take a little bit closer look at the second quarter. This chart underscores the unusual and difficult environment investors have faced in recent years, where both stocks in dark blue and bonds in orange have struggled, particularly during periods of inflation and aggressive interest rate hikes. Historically, bonds have served as a ballast to portfolios when equities stumble, largely thanks to falling yields that boost bond prices. However, the recent inflation shock flipped that relationship on its head. Interest rates rose sharply, dragging down bond prices at the same time equity markets corrected. The simultaneous decline of both asset classes in 2022 and 2023 marked one of the few periods in modern history where diversification failed in the short term. Yet 2025 year-to-date returns show signs of normalization, with equities up 9% and bonds recovering by 4%. This tentative rebound suggests that as inflation moderates and interest rates approach a plateau, the traditional dynamics between stocks and bonds may reassert itself. Now taking a look at major currencies, this chart shows the relative movement of major global currencies over the past 24 months, with notable volatility among the euro, pound, yen, and dollar. While the dollar initially strengthened, it has since moderated due to uncertainty surrounding Fed policy and interest rate expectations. The euro and the pound have recently rallied while the yen remains weaker. Monitoring exchange rates is critical because currency movements directly impact global trade, corporate earnings, especially for multinationals, and inflation. A weaker dollar, for example, can boost US exports and foreign earnings, but may also raise import costs. For investors, currency shifts influence international portfolios and should factor into asset allocation and risk management. Taking a closer look at fixed income, this chart compares total returns across key fixed income sectors, the U.S. aggregate bonds, investment grade corporates, and high yield since January 1st, 2020. It shows that despite similar starting points, performance has diverged significantly. High yield bonds have delivered a 29.1% return, far outpacing corporates 5.8% and the broader ag at 2%. These results reflect differences in credit risk, interest rate sensitivity, and economic exposure. It also highlights a core lesson for portfolio construction. Not all fixed income is created equal. High yield has benefited from strong economic growth, falling default rates, and higher coupons, but it comes with greater volatility and credit risk. In contrast, the U.S. aggregate index, which is heavily weighted towards treasuries and government-backed securities, has struggled in a rising rate environment due to its duration sensitivity. This reinforces the importance of thoughtful diversification within the bond sleeve of a portfolio. Additionally, incorporating private credit may offer a way to enhance risk-adjusted returns. Private credit typically provides higher yields than traditional fixed income with less sensitivity to interest rates due to floating rate structures. While it carries liquidity and underwriting risk, careful allocation to private credit can complement public bond holdings, offering diversification and potential return enhancement in a challenging fixed income landscape. Now turning to the economic outlook for 2025. We've gone over this a couple of times, but this chart can kind of show the cycles of the federal fund rate over the last 10, 15 years, with particular focus on the current rate cycle and expectations for the future. As of July 2025, the Fed has the lower bound of its target rate set at 4.25%, down from its recent peak of 5%, reflecting the beginning of a gradual easing cycle. The dotted line indicates projected rate cuts extended through 2026 and 27, ultimately converging towards the Fed's estimated longer run neutral rate, which appears closer to 2.5%. The key takeaway is that the Fed is signaling a slow, measured path towards normalization, assuming inflation continues to ease and the economy avoids a major shock. Now, this chart compares the trajectory of real GDP across post-World War II expansions indexed to a start of each recovery. The current expansion, which began in mid-2020, initially surged ahead of prior cycles thanks to massive fiscal stimulus and pent-up demand. However, growth has since slowed and is now tracking closer to the historical median. This suggests that the economy has shifted from a reopening boom phase to a more mature mid-cycle environment. What's notable is that despite tighter financial conditions and higher interest rates, the expansion has remained resilient, driven by solid consumer spending, a stable labor market, and ongoing business investment. Still, the pace of growth is moderating, and downside risks like policy uncertainty, inflation fatigue, or global shocks could test this cycle's durability. Investors should consider this a transition point where the focus shifts from rapid recovery to sustained but slower growth. This chart highlights the long-term volatility of U.S. economic growth measured by quarterly GDP on a seasonally adjusted annual rate. While the historical average sits at 2.8%, the economy has seen wide swings, most notably during the financial crisis and the COVID-19 shock. In 2025, growth has been mixed, with a slight contraction in Q1, as we've outlined before, followed by the rebound in Q2. This illustrates the fragile but resilient nature of the current economy, which continues to face headwinds from tariffs, policy uncertainty, and slowing global demand. Investors should recognize that while short-term GDP data can fluctuate, long-term growth trends remain relatively stable, and that macro volatility often creates opportunity for disciplined long-term investors. Now, this chart tracks the year-over-year change in the Conference Board's leading economic index, a composite measure designed to forecast future economic activity. Historically, sustained declines in the LEI, which is the leading economic index, have preceded recessions, which are shown in gray, often by several months. As of June 2025, the LEI remains in negative territory at -4%, a level that would typically raise red flags about an impending economic downturn. Indeed, this indicator has turned negative before each of the last 7 recessions, making it a closely watched signal for shifts in the business cycle. However, despite the negative LEI readings, the U.S. economy has so far avoided a formal recession. Several factors may explain this disconnect. Consumer spending, particularly in services, has remained resilient. The labor market, while cooling, has not deteriorated sharply, and fiscal support, along with pockets of corporate strength, especially in technology and AI, have helped sustain growth. Additionally, the unusual nature of the post-pandemic recovery, combined with structural labor shortages and shifting global trade dynamics, may have altered the timing or severity of traditional recessionary patterns. While the LEI suggests caution, the divergence from past cycles underscores the complexity of today's economic landscape and the need to consider a broader range of indicators. While the LEI has historically signaled upcoming recessions, today's mixed economic signal highlights the need for a broader view. Key indicators to watch include labor market strength, like payroll growth and unemployment, consumer health, such as retail sales and retail confidence, corporate activities, earnings and capital spending and margins, financial conditions such as yield curve and credit spreads, housing trends, and inflation dynamics. Together, these provide a more complete picture of economic momentum and help explain why the economy may continue to grow despite traditional recession signals flashing red. This slide highlights key divergence in economic activity. While the services sector, which is the non-manufacturing sector, remains barely in expansion at 50.8, manufacturing continues to contract at 49. These ISM indices serve as real-time barometers of business sentiment and demand. The split suggests that while the industrial economy is under pressure, consumer-driven sectors are still holding up, underscoring the uneven and fragile nature of the current expansion. And I will, on a side note, since we had the recent Truth Social comments coming from Trump regarding the Bureau of Labor Statistics and the firing of the head of that bureau because he didn't like the information, which is obviously not a good thing. One of the challenges, though, looking at the Bureau of Labor Statistics and the data that's coming from there, is that the the collection of data has deteriorated substantially over time. The BLS, the Bureau of Labor Statistics, relies on a traditional phone calls and emails and letters to gather data. And there's some serious lead time in that. There's also a deterioration in sort of the volume of data that they're getting. So on the one hand, the traditional data inputs that we get are still important. We shouldn't be questioning those. At least we shouldn't be questioning the process. The methodology can be improved, and I think there's significant room for improvement to understand what that methodology is. So, and I guess what I'm saying here is we're looking at non-manufacturing at 50.8, manufacturing at 49. But if the data coming in is really tardy, really late, or maybe we're not getting the same volume of data, we kind of, in a certain respect, have to question that. And I think that's the backdrop of sort of the geopolitical discussion around that. I think that we still need to rely on some of this data. It's very important. The question is, can we get better data? And I think that's going to be a discussion ongoing. Here's another index. This is the Citi Economic Surprise Index, which displays economic surprises for both the U.S. and G10 countries over the past 5 years, those economic surprises. The index measures actually how economic data compares to market expectation. A positive value means data has come in better than expected, while a negative value signals underperformance. As of July 25, 2025, the U.S. is modestly positive at 3.5, while the G10 countries are slightly stronger at 15.1. This suggests that economic reports globally have recently exceeded expectations more than those in the U.S., but both are in mildly encouraging territory. The chart also reveals how volatile these surprises reading can be, with frequent swings above and below zero. This volatility reflects shifting expectations amid policy changes, geopolitical events, and uneven data releases. The key message here is not to overreact to short-term movements. Instead, it serves as a reminder that while surprises can influence market sentiment in the near term, long-term investment success depends on broader economic trends and fundamentals than any single data point. Now, moving on to unemployment, this slide shows that both the official unemployment rate at which is the U3 at 4.1%, and the broader underemployment rate, which is U6 at 7.7%, remains well below their historical averages, signaling continued strength in the U.S. labor market. And I think this point can't be overstated. We are really seeing a tight labor market, which is good for wages and consumption. And that's an important offsetting factor when we're looking at sort of a declining leading economic index and other signals. So despite economic uncertainty and elevated interest rates, job availability remains relatively robust, supporting consumer spending and helping the economy avoid sharper slowdowns. This resilience is a key reason many analysts describe the current environment as a soft landing, right? Finally, this is our last chart. We're looking at global GDP growth and forecasts. And global GDP growth is expected to moderate slightly through 2026, with most economies projected to experience a slower growth in the coming years. China remains the primary engine of expansion, with growth forecasts at 4.7%. And then gradually easing to 4.3% in 2026. And then the U.S. shows a similar downtrend as well. I will note that the Chinese just came out with their most recent quarter at exactly 5.0%. I think what's notable there is I think it's inflated or elevated. There is a recovery going on in China, and that's important for the global economy, but it's probably a lot softer than the Chinese Communist Party is reflecting in its official data. At least that's what I've seen. So that might also explain some of the disconnect. Like, why are we getting such great growth, but the global economy is sort of like, limping along right now, even though it's in positive territory. Um, Among the developed markets, Japan's rebound from negative growth in 24, it shows a stabilization through 26 at a low 1.5%. And the euro area and the UK are projected to hover near or below 1.5, while Germany is even supposed to be lower through 2026. This subdued outlook underscores persistent structural challenges and geopolitical risks and slower productivity gains. Again, AI being a potential offsetting factor in all of this. So, I think it's warrants to be cautious in our macroeconomic outlook about how growth is going, but with sort of the positive undercurrent of AI and its potential to increase productivity, increase efficiencies, and things like that. So, moving on to the key takeaways. There's both positive and negative. I think I've highlighted most of those. The stock market showing some resilience, earnings strength still seems to be there. We have labor market stability. Consumer confidence is fairly stable. The service sector is definitely holding up. And then we see, the surprise index is improving. Those are all the positives. Obviously, the big sort of red flag in all of this is the leading indicators are negative, and it's perplexing why those would be negative in this environment, but they are. Manufacturing remains weak. I think that is largely around trade and tariff expectations of how tariffs and supply chains are going to react to each other. Global growth is definitely slowing. That's another negative. We want, prefer to see that growing. Interest rates are sticky, and there's definitely, as far as the U.S. is concerned, there's definitely a very big debt overhang which is a challenge that needs to be, dealt with. It's not going to go anyway time soon. I think the discussions around government spending, right, that we've been having lately are generally positive, even if we can, even if people disagree on the method of how we go about that, right? But at least we're having that discussion. I think that's positive. Some closing thoughts before we move on to questions. Stay focused on your plan. Markets are going to fluctuate sometimes violently, but your financial plan should be built for the long term. So that means staying grounded in your goals. Get off the doom scrolling on your phone. There's a lot of negative press out there. It's designed for you to click through. It's what we call clickbait, especially around, financial news and things like that. Just be careful of what you're reading, and remain focused on your plan in the long term. Keep your communication open, right? If you have questions about your plan or your portfolio, we want you to contact us. Certainly life events such as job changes or retirements or major purchases are all things that we want to know about because they can impact your strategy. Keep us informed. That's the main message here. Finally, think long term. Economic cycles go in long-term trajectories, as well as interest rate shifts, and market volatility is a part of that journey. So expect it. There's going to be volatility. We can certainly give you some background on that regarding your portfolio, what you can expect in your market as to market volatility for your portfolio. We can talk about that. Obviously, maintaining discipline. Don't run for the exits when market volatility goes up, and keeping a long-term perspective is key. So those are my closing thoughts. I'd like to open it up to questions at this point. If you have a question, you can put it in the chat. You can also I think you can raise your hand. I think you should be able to be muted so that you can ask a question. And you could put a question in the chat too. We should be able to read that. No questions at this point. Any market questions? Okay. Well, we've enjoyed having you on the program today. We are going to be making a video of this over time, probably a couple of days, and we're going to get that out if you want to revisit it, and obviously for people who were unable to attend. So if there's no other questions, we will say goodbye and take care. Until next time.